Look, a lot unknown at this moment. We have Centeno there talking about trying to get back down to 2%. I wonder our view right now of Europe, given that it has improved, given the energy story seems to get better, what are the biggest risks, identified or otherwise?
Maybe identified because it's well flagged, but if you look at inflationary dynamics in Europe, it's way above the comfort level of central bankers. Yes, now there is more talk about, at least in the near term, avoiding a recession, and the winter is milder than expected. Even Madame Lagarde is talking about potentially avoiding a recession. But given the framing of inflation fighting, and given where we are in the economic cycle, actually the more resilient economy seems to be at this point, the more potential over tightening is needed to bring about that demand destruction in order to fight inflation that is still running way above the comfort level of central bankers. So actually, I don't think we're out of the woods with Europe yet.
What does that mean for risk assets? That doesn't sound like a good environment necessarily to be buying into.
Well, there is a bit of a disconnect between the fundamental picture and risk assets that we have seen so far this year. If you look at what risk assets are pricing in at this moment, it's pricing in recession. Oh no, it's pricing in inflation going all the way back to target. It's pricing in avoiding a recession. Not only that, actually growth picking up from here, and at the same time, central banks will be able to come to the rescue of the economy and start cutting rates later this year. It's really hard to see such a perfect combination of macro outcome. We're not saying that it's not possible, but chances of that are slim. A lot of things will have to go right for actually what has been priced in markets this year to transpire, which is why we're feeling a bit, we're prudent at this point.
So, Wei, this I feel like, hi, it's Alex in New York, poses a real problem, because if you're sitting in cash and you're watching the markets continue to climb this wall of worry, you're missing out on some returns. On the flip side, if you invest now, you're kind of ignoring your medium or longer term thesis of things really rolling over. What do you do in that environment?
Well, actually, right now, if you're sitting in cash, you're getting paid almost 5% front-end treasury, which is actually somewhat attractive as a kind of a place to bunker down in as we wait for better kind of opportunities. But more broadly, it points to the importance of staying invested. So right now, yes, we see opportunities in front end of government bond market, which is as close to cash as possible. On the other side, we're also fully invested in that we see opportunities. We have been overweight high-grade credit for quite a long time. It's done extremely well, but at this moment, it's still paying you somewhat attractive levels to wait as we look at equity dynamics. So we like a high-grade credit. We like emerging market assets on a relative basis versus developed market assets that are priced almost for perfection. And then if you look at some of the broader dynamics like China reopening momentum, for example, there are still opportunities, even though it's becoming quite challenging given that disconnect between fundamentals and market pricing so far this year.
Where do you see the biggest disconnect?
The disconnect, well, developed market equities in particular, if you look at what they are pricing in rate cuts and also earnings to grow at a high single digit, and at the same time inflation going back to target, that's hard to materialize, which is where we are currently underweight at the moment. But of course, you know, when we talk about the year-to-date dynamics, momentum plays a big role, right? We're talking about a huge wall of cash on the sideline being deployed. Even in exposures like European equities, we're starting to see inflows. You know, like they're very under-owned exposures are starting to see traction. And in fact, what has been behind the year-to-date dynamics, yes, on the one hand, people talk about short squeeze, but we're also talking about real money FOMO inflows that have been supporting the momentum, which is also behind, in our view, this disconnect between fundamentals and also the price action so far this year.
So, Wei, what drains that money out? I mean, sentiment indicators show that people still feel pessimistic, even though they're putting money to work. What's going to drain it?
Well, right now there is a huge amount of cash on the sideline, so that's starting to decrease, but we're still talking about reasonably elevated levels. So it's hard to see kind of further cash to be put on the sideline from these levels. But thinking about immediate catalyst, tomorrow's inflation print will be key to watch. If you look at last Friday's revision, it actually shows that the last 3 months of excitement about inflation inflation, that we're out of the woods with inflation and inflation is going to fall back to target. Well, maybe we're too premature. If you look at core CPI is more persistent than the initial print. If you look at core service ex shelter is running at 5% versus the 4.5% analyzed in the first release, and even goods deflation is not as pronounced as the initial print, initial read. So all of that points to actually it's all about inflation. It's all about rate path from here, and that dictates risk sentiment at this point.